Good afternoon, everyone. Welcome. Thank you for coming to the 2016 Texas Housing Conference Equity Panel discussion. We've entitled the panel this afternoon, Getting the Most Out of Your Equity Relationships. And my panelists here, and I'll let them each introduce themselves here in a moment, but we were thinking through sort of the changes that are coming about in the equity market, just in terms of mergers and acquisitions. I myself have moderated this panel the last few years under a different company moniker. I'm actually Nicole Flores, and I'm with R4 Capital now. I'm an executive vice president with R4. We're a national tax credit syndicator and also have a bond finance private placement debt platform. So I asked each of my panelists to just give a brief introduction, maybe talk about their firms for a minute, and then I'd like to walk through a discussion of the current state of the equity markets and some of the discussions we've been having about relationships and making the most of your equity relationships. Dan?
Sure. Hi, I'm Dan Kearse. I'm with RBC Capital Markets. I've been in the light tech industry for about 23 years. I've been with RBC for 13. We've invested about $7 billion in our portfolio. We'll do about $900 million this year on the lower tier. Of that, we probably have about 125, 140 closing in Texas. We do proprietary multi-funds, as well as we can also do direct investing side by side with our investors.
Hi, I'm Josh Lappin with Hudson Housing Capital. We're a tax credit syndicator based in New York. I have a fairly large presence here in Texas. I've been with Hudson for 6 years, and when I started, I took over acquisitions for the Texas market. Nationally, we do about $500 million, and in Texas, we do around $80 to $100 million.
I'm Gary Robinson. I'm with Raymond James Tax Credit Funds. We are a subsidiary of Raymond James Financial. We're a New York Stock Exchange traded, publicly traded company, about a $7.5 billion market cap. Been syndicating tax credit deals for about 30 years. To date, Raymond James has syndicated about 1,800 properties with about $6.5 billion in equity. Last year we did about $860 million in equity. We'll probably be pretty close to $1 billion this year. I cover Texas among some other southeast states for Raymond James, and I've been there for a little over 15 years.
And I want to make apologies and send sympathy to Bernie Husser with Richmond Group. Bernie was going to join us on the panel today and give you a fresh perspective, since you've seen some of our faces a few times, but unfortunately had a close friend pass away yesterday. So Bernie's not joining us this morning. And I apologize for seeing the same faces up here, but I believe the message today is going to be a little different. I think the last 3 or 4 years we've been sitting on this panel and coming to Texas and talk about equity pricing. We've had nothing, I think, but glowing things to say, and sort of sky's the limit, and add a few more cents to your bottom line, and let's keep moving forward. As I said, we'll sort of have a discussion here in a moment about some of the impacts or things that are impacting the equity market, but I think this is one of the first panels in the country where you're going to hear that equity pricing is likely going to cool in the next 12 months. I don't think there's going to be a significant swing in the changes in the equity market, but one of the things that we're seeing is we're starting to see some pushback, at least at my firm, R4 Capital, in terms of the summer funds that are coming out and the interest from investors in those summer funds. And some of the reasons for that are likely global. And one of the most recent sort of major changes that happened was the Brexit discussion that we had a few weeks back. I think it's been about a month now since Brexit, and that vote hit the world. So I wanted to ask Dan. I have some anecdotal feedback for what we heard and saw around the time of Brexit, but I wanted to give each of the panelists just a few minutes to talk about maybe some of the impact you're seeing with investors, some of the feedback you're hearing, and maybe how Brexit maybe started those conversations or started the changes.
Yeah, it's like and interesting to hear some of your stories as well. But for some of our investors, I think they were anticipating interest rates going up, and when Brexit happened, because their theory was, hey, we think interest rates are going up, which means yields are coming down, so why buy tax credit deals this year when we can wait until next year to do that? And let's just cool off our investing. And actually Brexit happened, and we weren't sure if that was going to recalibrate that thought process. And they're still working through that, but there's definitely been some yield buyers out there that we still feel like, are they in or are they out because of, but Brexit is playing a factor into that decision.
And just talk a little bit, so will you give us the description breakdown, and some of you in this room know this very well, but yield buyers, CRA buyers, because the big change we are seeing is economic or yield buyers. And what does that mean at Hudson?
Sure, at Hudson, so we deal actually for the most part in proprietary investment funds. So our when we find equity transactions to invest in, there's a single buyer. That may be Capital One, JP Morgan, Bank of America. And so most of our buyers are banks. And so those buyers are CRA motivated investors. They're investing in your tax credit deals because they have to put out money in markets where they take deposits. So in order for banks to merge with other banks and to stay in business, they have to have a good, strong CRA rating. And so you'll see really in the major metros where the majority of deposits come from, that's really, that's where a lot of the banks put their dollars. There are other investors in the market that are yield motivated investors, and those are insurance companies. They may be companies like Google that see opportunities in outside of the major metros, typically, where they can generate yield maybe 1% higher than what the CRA investors are paying in the urban markets.
Yeah, I'd say just to add on to that. So at Raymond James, we do both proprietary and multi-investor funds. So we kind of got our finger on the pulse on both of those, and just kind of talking about sort of what's going on right now. And Nicole alluded to kind of the summer funds, which is kind of a typical cycle kind of in our industry where about this time folks will be out kind of selling, quite frankly, funds that a group of deals, call it 20 different tax credit deals across the country that are either closed at the lower tier or have been closed or are in the process of being closed, but certainly identified, where we're putting together investors with an actual fund. This is kind of about the time traditionally when a lot of these funds are sort of being marketed right now. And what we're finding right now is, as opposed to a year ago, where literally we took our kind of our summer multi-investor fund, and within a day we were well oversubscribed. Right now what's going on is there were some funds that have actually been out there before ours that aren't necessarily getting the traction. Not that the investors aren't necessarily there, but it's more of a function of maybe that yield is just not high enough to entice enough investors in. And so there's kind of some things going on right now where folks may be at the upper tier. Now, mind you, at the investor level where they're sort of selling these funds, where some of these might be repriced, but I don't mean at the lower tier. I mean priced at what an ultimately investor is going to buy. So where maybe 5% was kind of the magic number somewhere along there, maybe it's 5.25 now that various syndicators funds are going to have to go for. So ultimately, and we'll sort of talk through this, these are all signs that maybe you could call it softening. I don't necessarily know if that's necessarily the word, but it's certainly, I think what we're calling it is certainly a plateauing by all means of pricing, particularly on kind of the non-CRA markets.
And I think you're talking about deals that are already closed and so committed. So now when you're looking at prospective transactions that are out, that aren't in these CRA markets, you're going to be sort of pricing with the thought of where people are now currently buying.
That's right.
So
that's right.
Yeah, and it's interesting too, because when you're doing multi-funds, you're putting multiple deals in there, and the banks are very drawn toward the CRA investment. So every fund is going to have a percentage in there that are just CRA-driven banks, but you're going to have deals in there that may drive the yield, but you need a non-CRA buyer to buy that. And that's an important component for many of the funds. And so those are the folks, those economic buyers that are kind of drawing a line in the sand. And so, you know, as we went below 5 on multi-funds, I think that's when we started to see some of those folks pull back. So people would test the market, go out hoping to sell it at 475, getting those funds out there. And if they didn't move, well then, hey, naturally it's going to be 5 or 5.25. There were a couple actual yield buyers out there that were picking up some funds and saying, hey, you were out there at 450 or 475 and you couldn't sell it, but yeah, we'll buy it at a 5.25, but at least we're getting the product off your books. Because again, most syndicators are not, they're borrowing that first installment to aggregate a fund and sell it. So there's an incentive to get that fund moving quickly to free up that capital. But yeah, clearly what we're seeing is, yield buyers are kind of drawing a line in the sand, and so those guys are kind of sitting back and waiting for things to change.
And what does that mean for all of us here in the room? It means that the market is plateauing. It means that there's some question. I mean, generally, the experience at our firm the day after Brexit happened was one of our largest investors, which is an insurance company, which is a yield buyer, which does have a platform or a floor at which they won't go below, called and said, well, our corporate international headquarters are in Germany with offices in London, and we don't know what's going to happen with our corporate headquarters. We don't know what that's going to mean in terms of cost of relocation for some of our offices. And so they basically just said, I think we're just going to wait for a few months and just sort of see what happens. I talked to a second insurance company that day. Wow, we have a huge corporate office in London, and we don't know what this means to our future or where our staff are going to be located. So, the Monday of Brexit, we talked to several insurance companies. The Tuesday after Brexit, one of the largest banks in the country calls and says, we'll buy anything you have over a 4. As interest rates are diving off a cliff, they're suddenly wanting to put as much money as they can possibly get into locking in an interest rate. So overall, what does that mean? There's a lot of confusion in the market right now. There's confusion because the 10-year is at an is at an all-time high, and we've set this or all-time low, excuse me. And we've set this room for 4 or 5 years and talked about the 10-year being at an all-time low, and that was 50 basis points ago. So a lot of confusion in the market means that we will likely start to see some of what we saw in 2010, 2011 as the market came back, which is a differentiation between markets, where there's going to be more interest in a CRA market where you have a bank that has to buy that product, that has to place that deal, versus perhaps a deal in rural Texas that's no longer going to be competing at over $1. And again, I'm not Chicken Little, the sky's not falling, but certainly the upward pressure where, let me just throw $1.12 at it or $1.10. The other thing that I think that we're going to see, and we can also talk about if you're hearing this, one of the things we heard from our investors this summer for the first time is, what's the leverage in your fund? What's the hard debt leverage? How many bond deals are you doing? And again, for those of you who've been in this business for a while, you can remember a time 5 or 6 years ago where you couldn't sell a bond deal, especially a highly leveraged deal. And the market has been somewhat indifferent to those transactions. Is that your experience, Dan?
Yeah, no, absolutely. So, and it's funny, when you're getting oversubscribed on your multi-funds, they're bigger funds, you can throw a lot more bond deals in there and hide that leverage. It's funny because we did a lot of bond deals, but they look like 9% deals. And we actually had one investor say to us, you know what, your funds are so much lower leverage than everybody. And we're like, yeah, isn't that great? It's safer. And they're like, we don't care. Leverage them up, get the yield. And that was actually their advice: go do more bond deals. And I'm like, you're nuts. So yeah, it is a little crazy, but we're seeing more bond deals coming through the pipeline. I think we all are, and especially here in Texas, which is good and it's healthy. But yeah, you got to be careful because we're now in an environment where construction costs haven't gone down, right? We still anticipate that at some point in time here, interest rates should go up. There's many things that can impact that, and they seem to continue to do that, right? We're still waiting for the Fed to increase rates, and it hasn't happened because there's so many bad things happening. And now you're seeing, credit pricing kind of hit the peak. And then on top of that, we also have this factor, at least for this year and I think a little into next year. It just so happens that a lot of these large banks that are investing, their three-year CRA cycles are kind of coinciding. So not only do you have some retreating on the multi-fund side, but on that proprietary side, these banks now have got 3 years to fill their buckets for CRA. And so they're going to say, we don't have to buy anything today. We got 3 more years to do it. And so we've seen a bunch already pull back and say, for a particular location that we have unlimited demand, like Houston or Dallas, sure we'll pay. But other than that, we're going to sit tight.
Yeah, and we've seen some of that even for the end of this year. So a lot of the larger investors, the CRA investors even, have filled up their funds and filled their quota earlier this year for deals that have closed. So if you're trying to get your transaction closed this year, maybe the pricing will stay flat, but it's probably, people aren't going to go hard after those deals closing this year. I think next year might be a little bit different, at least on the CRA front. I think when people come out with a new CRA cycle, well, I guess they don't have to buy at the high. I think sometimes you want to also, it's the devil you know, I guess, in terms of where pricing's at. So you can sort of jump in and at least get some of the good deals with the developers who you have, good, strong relationships with, and make sure that you have some solid deals already sort of in your bank for, and then as the cycle continues for the next 3 years, you can sort of fill it, and hopefully the market comes down a little bit.
Right. I think it also speaks a little bit to timing. Over the past couple of years, you definitely could get a 9% award, let's say, into July, and quite frankly, if you waited an extra month before you kind of signed your deal up, it was an extra penny. And I think we were all up here, certainly over the past 2 years, at least, saying, I'd be careful, I'd be careful. And a lot of that, I think, was more along the lines of, we're kind of looking at each other saying, pricing can't get higher than this, can it? But the reality is, right now, we're actually seeing hard evidence. So it's not like we're just saying it can't possibly get better than this. We're seeing facts right now that are pointing to it's not going to probably get better than this. So I think the strategy of cool your heels and let's see where that first deal gets priced in Houston, or that second deal, and I'll be the third one in. Maybe that strategy will work, but I'm not so sure this year.
And one of the constant themes that we've had, over the last few years in this panel, and again, the name of the panel today, is getting the most of your equity relationships. I think the most important thing is going to be keeping those lines of communication open with your finance partners, discussing deals with them. I think most of us have all had our heads down making hay while the sun shined the last few years, and you package in a deal and you've got your head down, and then you get to a certain point and you give it to your syndicator of choice, or your small group of syndicator of choice, and you think there's always going to be appetite for that transaction. And the good news is there likely will be appetite for it. The question is, where do you peg that pricing? So I think we've probably put enough of a caveat on pricing now that everyone understands there's going to be some pressure on that. Again, I don't think that it's any devastating news. I don't think there's going to be a significant downward trajectory. I just think there'll be a softening. And any of us on this panel or any of your equity relationship managers can talk you through that and give you indicative pricing. And again, I don't think this is going to be a major retreat. So let's move on from pricing and talk about the types of deals you're doing. Our shop has been doing a lot of RAD transactions and a lot of PHA joint venture transactions, which obviously bring with them benefits of tax abatement and other things. But how are your investors receiving RAD transactions? Are you seeing those underwriting issues with RAD transactions?
Yeah, it's I got to tell you, everyone loves RAD, right? So it's such a win-win for everyone involved. The investors love those deals. Again, you've got a housing authority involved, and typically in a lot of cases, a for-profit developer developing those. So it might be an experienced partner that you've worked with. They're going to bring it to fruition, and then let the housing authority take it from there. The subsidy that's involved, there's a perception from investors that, hey, these are safer deals than just your typical run-of-the-mill LIHTC deal, just because of the involvement with the housing authority and whether it's Section 8 or some additional subsidy. The other thing is that typically there's some other soft funds coming into those deals, so the leverage profile has been much better, which is good. We've certainly seen some 9% deals, but we're seeing a lot more 4% on the RAD side. Yeah, so far it's been great, and you've also got an existing tenant base, so it's not like, hey, we're going to build this and we've got to hope that we can release this thing, and that we're not sure where the tenants are coming from. So from the RAD side, we're seeing a lot more of it. Investors love it, and we just see more stuff coming through the pipeline in that regard.
I would say the RAD rents are pretty comparable to where the tax credit rents are. So we make that to this another point, but something that does make investors a little bit nervous is subsidy and operating subsidy and the appropriations of that operating subsidy. So if you have Section 8 rents, oftentimes you'll see Section 8 rents that are in excess of the tax credit rents. So if you were to lose, if you rely on that and size your debt accordingly, and you lose your your Section 8 operating subsidy, you might not be able to service your first mortgage. With RAD transactions, the RAD rents tend to be right around sort of the 50% AMI rents, and so that, from an investor standpoint, is great because you sort of have a surety of income for a good chunk of units.
You know, I think on these RAD deals too, the deal itself seems to have matured in the sense of, you know, when they first came out, there was a lot of questions. Some banks had some issues with certain aspects of the documents and, you know, sort of a laundry list of things. It seems like all that has kind of gotten worked out by now, and they're certainly a little more complicated, but kind of the unknown factor, I feel like is gone, and we're seeing a fair amount of them as well, and so they just seem to be humming along a little bit easier than when RAD first came out.
Right.
Yeah, so Josh, you brought up the Section 8 overhang issue. Let's talk about Section 8 in general. I mean, are your investors still looking for guarantees related to that Section 8 overhang? How are you working with that?
They're not. I mean, so each investor is different. So you know, I'm thinking back, even 4 or 5 years ago, we had investors that would insist on having, if you had Section 8 overhang, they'd want an operating reserve equal to kind of 1 year of the Section 8, that we call it the incremental income, the rents in excess of your tax credit rents, held in an operating reserve, plus a guarantee, plus a springing guarantee that would come in place. So there's just all these layers, and really over time and even until now, we've just seen a lot more people get comfortable with Section 8 appropriations. But we do have, we always want to model, in our view, a downside scenario, and we will run the numbers assuming that you lose Section 8 and see what happens to debt service coverage. Ideally, and many states allow this, so Texas has not gotten there, is that if you lose your Section 8 operating subsidy, and typically those cover your 30% AMI units, a lot of agencies will allow, to maintain financial feasibility, the rents to come up to 60% AMI rents. And so normally under those scenarios, we're able to show that we don't have an issue with Section 8 overhang. And so showing that to an investor and saying, yeah, there's a plan here. If we lose Section 8, it's highly unlikely. We're able to get our credit groups comfortable.
Texas's QAP over the last few years has also had, points for market rate units, percentage of market rate units, which I know, the investor community at first and a large percentage had issues with that. Have you closed deals with market rate? How are those working? What are investors?
Yeah, and I got to tell you, it's one of those things. It's taken them time, and we are actually closing on a deal now that's 50% market rate here in Texas. We've actually got 2 of them and a third one coming, and investors really get nervous once you pass that 20% market rate threshold.
Dan's throwing out a gauntlet for you here. 50%
Yeah,
market rate units. Any of you, if I was talking to you one-on-one, I would tell you never to do it. So
it's
call
nuts.
Dan Pierce.
It's nuts. Yeah, don't get any crazy ideas.
Sorry,
But the way that we looked at it, and kind of going back to relationships, if someone walked into our shop and said, "I've got a deal with 50% market rate," the first answer would be, "Thank you, but no thanks." It just so happens that this is someone that we've worked with a long time. And so we've got a track record with that person. And so their first deals were 100% LIHTC, and then it was 10%, 15%, 20%. So we've got a track record of saying, hey, first of all, they build a market rate property. They manage a market rate property. And they really kind of shifted their business model to say, you know what, we don't call this a mixed use. This is a mixed income. And we really like having market rate folks and having that ability to, anyone that walks in the door, we can lease an apartment to them. Because so often, someone would drive by, see this beautiful building, and say, I want to live here. And they were over income qualified. So we've got this track record now of saying, hey, they can manage this, they can operate it. We're getting, every single time we underwrote their rents much more conservatively than what they could get. So the good thing is they get the upside of higher rents if, over our conservative underwritten rents. But if there's a constriction in the market rate side, then we're still covered. So it's been an incremental kind of twist. And so when he was putting in his application, he's like, I'll I'll score better if I can get 50% market rate. We're like, please don't. And I kept sending them these emails like 75%, you know, LIHTC, 25% market's good, you know, lots of investors, it's good, and then the app goes in and it's 50%. I'm like, so, but we are doing them. We're seeing a lot more market rate units, but again, it's been generally more in that like 20, 25%. I've got a bunch where they're 40%. But again, you know, when you look at where the QAP is this year, last year, we're not necessarily in the QCTs like we used to be, right? You're forcing developers to go into these better communities, better neighborhoods, better locations. I can't tell you, I mean, how many deals we've got that are right around the corner from a Target or Walmart just in the past. Now granted, the land's more expensive, so the deals are tougher to pencil. But we, you know, there is that acceptance of underwriting market rents, but it carries with it more risk. And so with more risk means someone needs to get rewarded for the investor, and maybe that is, it's a relationship. It's someone that they really like, someone that's got a pipeline of deals. Or is it, can they get better pricing? In one case, what we did was, you know, the market was gearing toward more aggressive terms. And we said, hey, if you're gonna have that much more market rate, that's that much more debt, we want bigger reserves, they're sticking around, longer operating deficit guarantee. And the developer said, you know, that's a good trade-off, I'll do that. So they are getting done, we're seeing more of them, and they are tricky, but that's where that relationship comes into play.
Absolutely, being able to use tools to structure around it to where, you know, terms might be different or requirements may be different, reserves may be different, but if you want to do this type of housing, also having the experience. I mean, so I've been seeing a lot of deals lately that have commercial income in them, and I'm interested to see how the market is responding to that because, you know, for LIHTC investors, commercial used to be an absolute no-go. I remember back when Campbell Hogue did their first downtown Austin deal on 6th Street, and it had this whole strip of commercial, and I think they talked to every syndicator in the industry to try to get someone to invest in the commercial piece, but we're looking at several transactions right now that have a commercial component, and it's a very similar conversation. It's, you know, what sort of experience, not that you're purely a high-tech developer, but that you've got commercial knowledge, commercial experience, or you're bringing in a partner, or you're bringing those leases up front. Are you seeing commercial? I mean, you guys do an awful lot of urban deals. Are you seeing commercial component?
Not in Texas, at least I haven't so far. I mean, we have it on an older transaction, but it was never assumed in part of our underwriting, so that, you know, the developer really sees all the benefit if and when they lease the commercial space, which hasn't leased, and the deal's been has been converted as very successful, but it's been a few years now. But you know, we do an awful lot of work in New York and DC and Chicago and all sort of the major metros on the East Coast, and we do see commercial in all those transactions, and that's really a big push for certainly the New York agencies, is to make sure that there is commercial, first floor commercial in almost every building we do. And the market's really, you know, fortunately the market has improved in all these areas that we've gotten more comfortable with it. But in a place like New York, it's really easy. But I haven't seen it yet in Texas, but I think, you know, I think it would be challenging actually here to see.
Maybe, I mean, so I think our experience is the same. Certainly in the big metro markets, New York, some spots in California, you can kind of see a bigger portion maybe of the overall deal that's commercial. Maybe somewhere in a large market in Texas. I mean, if anything, I'd say maybe it could be something that's complementary to it. But all things being equal, when you got 5 other deals and 4 of them are 100% tax credit, and you got this one that's got 40% market rate unit in a commercial space and penthouse or whatever, you know, we'll pass on that one, and we'll just go with the 100% LIHTC. So I think it kind of depends on the markets. Like you said, certainly in some of these big markets, it's pretty common. But as you step outside of that, I think it's more of a complementary kind of piece to the transaction.
Yeah, I agree. And so, especially the deals here in Texas, kind of in the central kind of region through the U.S., you know, that demand isn't as there as much for the commercial income as it would be on the East Coast, West Coast, or major downtown areas. So, you know, typically, you know, for the commercial space, we're underwriting 0 for it and still getting a master lease. So as part of
still getting a master
And still getting a master, just in case, and it's like, you know, you can white box the space, so a good chunk of that cost of building it is still kind of in the deal that we're paying for. And so it's almost the way that we structure them, it's like upside for the developer. If they can actually find someone to put them in there, then great, then they can get the benefit of that. They can bear the cost of building out the space, you know, so that works. But yeah, other than that, we're just not seeing, you know,
And that's the issue we've had. I mean, our deal with the first floor commercials in Dallas, and so the hope was to bring in the local college to run some training programs out of that space, and it's taken a while to negotiate the lease and to move forward on it. And had that been had we assumed that in part of the underwriting and needed to support the debt service, I mean, I would have held up their conversion for 2 years.
Yeah.
You mentioned debt service. Let's talk about that for just a minute. What debt service are you seeing on 4s and 9s this day? I mean, pretty consistently, I think 9% deals I've always been at a 115, but I'm seeing a lot of pressure and a lot of acceptance at a 115 on bond deals, which, you know, in the past, I think for the past 15 years, we've been at sort of a 120. Are you seeing a dissolution to 115 on the bond deals you're looking at?
You know, again, going back to relationship, right? So first time developer with us, you know, maybe we want to size that to a 120, but honestly, if someone that we've done a dozen deals with walks in and says, I need help on this deal, it's, you know, and I need to underwrite to a 115. If we feel confident about the sponsorship, confident about the market, where we're underwriting the rents and expenses, we can gain some comfort with a 115. Kind of going back to that discussion about, you know, 9% deals with a high amount of market rate units, something like that. Instead of doing a 115, we might do a 120 or 125.
Well, that was going to be my question.
Yeah.
Do you use that to help structure?
And so we definitely use that as part of the structure. And ideally, it's, you know, 120 on a bond deal. But you know, we have made some exceptions to that. And concurrently, we've had some, you know, 9% deals where we say it should be a 115, and maybe we want a 120 or 125.
Mm-hmm.
And I think, and we've also benefited from rates declining. So I don't know if you've probably all seen this too. When you actually go to close a transaction, we end up locking an interest rate. Something that we may have been underwritten at around a 115 or 120 is actually rate locking and then closing at 130, 135, 140. So we're sort of benefiting from the dropping interest rates on the debt side. But that, you know.
Well, and I wonder from the developer side too, in terms of managing that, because in most states you have sort of the under-over in your debt service coverage too. So from a developer's perspective, I don't know if anyone has any feedback from the audience, but you know, it's wonderful to get an interest rate that drops 40 bips or something. You know, we all remember when it went the other direction.
Right.
For us sitting up on the panel, unfortunately, that's not necessarily a good thing, because a drop in interest rate is going to hit our yield and our return and losses, but it definitely has additional proceeds. And the difference between a 115 and a 120 on a large bond deal can be hundreds and hundreds of thousands of dollars. So that is one term that I think I have rarely seen bond deals done at a 115 since the heydays, and I've seen a number of bond deals, and it'll be interesting to see as the conversation we talked about plays out with 4% bond transactions. If they become less attractive in the market, will this push to a 115 debt service coverage sort of evaporate?
Yeah, I also feel like, though, it's still the difference from, say, 10 years ago is the folks that are getting the 115 debt coverage. Part of the analysis that we're doing is strength of guarantors, strength of the sponsor. You know, I feel like, or maybe it was longer than 10 years ago, anybody that sort of came off the street, they were doing bond deals at a 110 debt coverage. I mean, who knows what was going on back there, and it was a disaster. I mean, at the end of the day. I think we are looking at this now saying, what is the difference between a 115 and a 120 debt coverage? You know, here's the amount of loan proceeds. It's hundreds of millions or hundreds of thousands of dollars, but at the end of the day, we got a guarantor that's net worth is many, many times that. And so there's mitigants to sort of going outside of the box a little bit.
Right. Yeah, and if you're holding that differential in cash developer fee, so let's say that difference between a 120 and a 115 was $500,000. Well, that's $500,000 more rate cash developer fee. So hold it till stabilization.
Right.
So it's like, you know, by the time they get to stabilization, you know, maybe you get higher rents, you still get your performance expenses, so maybe you do that. So if something bad happens, then you're holding the cash fee.
So Gary, you mentioned guarantees. What has anything changed with guarantors or guarantor strength or sort of, benchmarks? Do you have hard and fast benchmarks for that?
I think if you were to ask me you got a guarantor, what's sort of the industry standard minimum amount that you're sort of looking for? I would throw out a $5 million net worth with $1 million liquidity, just as kind of the starting point. We do a lot of deals, and that's not necessarily the case. And so it does go back to sponsorship. Maybe this is the 20th deal that this person's done in Texas, and they've got a long history of this, or kind of a variety of things that could sort of be going on to sort of sway outside of that. Regardless, though, if you got somebody that's got a net worth of $500 million, I still don't think you've got an investor that wants to get into a deal that's not good. So this is sort of just going under the assumption that you've got a solid deal right now. What's kind of your minimum sort of benchmarks that you're looking at?
Yeah, I think we all sort of nodded our head at those numbers. I think that's probably a decent starting point. Have you seen we talked last year about pressure on terms because pricing was so beneficial and is still beneficial even at the levels we're talking about. But dissolution in terms, I really expected that we would start to get a lot of pushback on like the 5-year operating deficit guarantee period, which is sort of sacrosanct in our industry.
Right.
But I think the industry's pretty much preserved that. Have you seen?
Yeah, and I agree. And I really, I saw more asks this year on a lot of the terms. But it's funny because it's still the same case. When you sit down with your investors and say, here's the deal, here's what they're asking for, the answer will come back, we'll pay that lower yield. We'll buy that deal, but you better give me clean terms. And, we want the 6 and 6 reserves. We want the 5-year operating deficit guarantee. And that happens so often, and we just keep thinking, okay, the market's pushing. We'll get back to where we were kind of, pre-recession, and I haven't seen it. And cases here and there where we're giving terms, and again, it's to that large developer that you've worked with for the past 20 years or something, you've done 1 million deals with. But for the most part, I think that the terms have helped.
Yeah, so that I feel like that's pretty consistent as well. What about one of the things that we're seeing a lot of focus on, and I think maybe this is all of us just growing up in this industry and getting to the back end, but I'm seeing a lot of pushback on the back end transactions. And I don't know if that's because of our friend Barry Palmer, and he's been very good at sort of educating folks, or it's an outcome of some of the sales and transition in our own industry. But are you seeing a lot of pushback on back end issues?
Yeah, so that was probably a big holdup in a lot of our early negotiations from allocations made last cycle. Is developers were sort of waiting, knowing that Barry was sort of working through some language about how to deal with year 15 and having the developer not liquidate the partnership and then but instead buy our partnership, by the LP's interest in the transaction. And so that's there's been a lot of pressure, and it's something that we couldn't sort of make the decision on our own. We went to all of our investors, frankly, and sort of vetted some year 15 language to make sure that everybody was comfortable with what we were sort of going out with on the deals that we were signing up. We wanted to, we didn't want one investor to be surprised with something we had given to somebody else. We try to keep our terms overall consistent with the deals, but yes, there was a tremendous amount of pressure.
Right.
And really all this, I think, is certainly coming up because we're now seeing en masse deals that are coming out of year 15 compliance. It's really not year 15, it's like 16, 17, somewhere around there. And so just mutually, I don't think it was a deal point that a lot of people put a tremendous amount of time thinking about 15, 20 years ago about sort of this, what happens at the end. But clearly now, folks have been in this business this long, and they're starting to see deals sort of recycle out of this, and they want to kind of maximize where they are with it in terms of our general partners, which I get.
And there have been a number of mergers and acquisitions of other syndication firms, and so the person maybe that you're dealing with on the front end of transactions, if the deal is getting sold to a different investor or syndicator, it could be challenging to work through some of the year 15 issues. And I think folks in the industry have seen that, which is part of why there's been a push, I think, to make sure now that deals that people are getting into, the language works for them, and they know what year 15 is going to look like. There's just a lot of uncertainty with some of the deals that have been sold to other syndication firms or investors or hedge funds, and so I think a lot of the feedback we get from developers is saying, look, I want to know what I'm getting into.
Yeah, and I think we're probably heading towards a place where we have a fairly standardized language for that back end, because I think we all have sort of unique interpretation. If you looked across, maybe 7 syndication letters, and I think maybe that's becoming sort of like the 5-year ODG, which is pretty much, it is what it is, right? And this is as flexible as the industry is going to get, because one of the things that we struggle with is ultimately our investor does not want your deal. I mean, despite the horror stories you've heard, our investors want out at the end of the day, and that's probably the biggest challenge you're going to have when you look at that route, when you look at the sale at the end of either the initial credit period or the compliance period is, I've seen some language recently that basically just leaves an open-ended option period, which never gives the investor the opportunity to exit the transaction. Or it's been suggested to us that we accept language that at any point, just here's $1, I'm leaving, and so, but I think there is some pretty standardized language out there now for the back end. So any significant changes to underwriting? We talked a little bit about commercial income and various types of income. Is your underwriting process changing any nuances to that process? I'll start with you, Dan.
Yeah, I mean, it really has just been pretty much the same from an underwriting standpoint. We always look to the developer to give us operating expense comps, which is always nice, and we utilize our portfolio as well to compare against that. But that's one thing we've always kind of done. Kind of going back to your point earlier, 10 years ago when we were looking at deals and those bond deals that were done, they were really kind of slapped together quickly and off they went. But ever since the recession, that attention to detail, I think, both from the investors and the syndicators, there's a lot more attention on the underwriting. So I think it's been consistent. I don't see anything new this year, but clearly there's a lot of eyes looking at this stuff. And so for rents, expenses, that's all going to be verified. Construction costs is another one that we're spending a lot more time looking at. So when numbers come in, I'm always pessimistic about, as we're kind of underwriting the budget, we have a sticks and bricks guy, within our shop that's going to look at that and say, hey, those construction numbers look good, those construction numbers look aggressive. But it's tough because we always end up signing these deals up, at one cash developer fee level, and by the time that hard bids come in, it's a completely different deal. But from an overall global standpoint, other than really kind of focusing more on the construction costs, it's been pretty much the same for us.
What about property taxes here in Texas? Because I've lived and worked in Texas for 25 years, and I'm still really confused about what the cap rate should be. And I've looked at deals in the last 18 months that have had taxes estimated anywhere from $1,650 a unit all the way up to like $1,650 a unit. And I know for many of you who are involved in the TAP organization, this is a legislative issue that TAP is planning to focus on again this year, is again attempting to rewrite the legislation so that there's a uniform interpretation of the property tax issue. But is that something you're struggling with? Because I've literally had several rural deals where we've ended up with this extraordinary tax number and really sort of trying to back off of that and justify that number.
I mean, we've run into some issues even in some of the larger metros like Fort Worth. We were looking at just comparing operating budgets of various deals, and found that on a comp actually we were involved in, the taxes were significantly higher than what we had underwritten, and it's the appraisal district just expects you to go back and sort of appeal their decision, and then they'll come down on their value and come down on their tax number, and then they expect you to actually threaten legal action, and then they'll again drop the taxes, and it actually ended up getting back down to where we had underwritten. The formula's sort of there as to how they value it, using an NOI approach and a certain cap rate to determine the tax value. So I think it's really once you do get your tax bill, there's a lot of back and forth with the district that has to happen. So I think it's a good issue for TAP to take up so that doesn't happen.
Yeah, and I would suggest that there's often an impression, that we're sort of syndicators or investors on this side of the table and you're on that side, and, we always seek to define it as a partnership, but I think this is genuinely an issue where everyone in this room could be a party to the issue because it affects us all, and I think we could speak with one voice. So I would definitely sort of go off script here and just urge you. At TAP, we're trying to improve, especially during this legislative session, the communication about hearings, processes, bills that are routing. But Bobby Bowling, who's the incoming president of TAP and is a fellow developer, a 9% developer out in El Paso, this is a passionate issue for him. It's one that he and I have been talking about. A number of us in this room have been around since the Chodo tax legislation was passed many years ago and subsequent tax exemption legislations. But it does appear that in Texas, if you don't want to litigate and you want a fair cap rate assigned to your affordable deal, we're going to have to do that legislatively. So if you have any passion or any story or any anecdote you can write down or speak at a microphone about your property tax issue, we don't want to come to you and say we're coming up with expenses that are $5,000 a unit, not $4,600, and the big difference is right here in this line item, because I've had the exact same experience as you. I've had my developer send me comps within his own portfolio where there's hundreds of dollars of swing, and I understand each appraisal district acts independently, but we've got to work to cap property taxes per unit in Texas on affordable housing, especially because of construction costs and some of the other things. Yeah. And then I'm sure anyone in the audience could give us a speech about trying to find the right piece of dirt at the right price in the high opportunity area that meets that little tiny box, and gets you that appropriate scoring. So I just want to take a moment and plug property taxes because it is a big issue, and I think it's one of the few challenges. Luckily we have a lot of experience and there's a lot of anecdotal evidence, but when you're trying to convince an underwriter who may not be sitting here in Austin, Texas, that at the end of the day they might have to challenge it, but my taxes will be $600 a unit, that can be a challenging discussion. And I think in the past when we could look at the Chodo legislation and say, here it is, this is what says my taxes are going to be fixed, I think if we have that piece of legislation here in Texas that tells all these appraisers how to value your properties and doesn't sort of leave a gray area for them to assess, I think that would be very helpful for all of us. So again, apologize for that sidebar, but I think it's an important issue. The last question I had, and then we'll certainly open it to the audience because we've hit a lot of these on the list, but are you spending time, now that we're all growing up and growing older, do you spend time on succession planning or sort of underwriting some of your key clients as folks are retiring and sort of moving on from tax credits, they're a son and see at the end of the deals one of these days? Are you doing succession planning? Is that something that you look at your firms?
It's funny because we've actually got a lot of clients in which the next generation is taking over very well, and some of our cynical folks in the credit department always joke about Tommy Boy. It's kind of do we have Tommy Boy or do we got someone that's really going to be able to run this? And so that's really the question, and not so much hey, if the developer gets hit by a car, what happens? It's just more of just spending time with that next generation is we've been coming through, and I've got a bunch of these where the sons are taking over the business, and sometimes it's a different style. The dad might have gravitated toward more rural deals, and all of a sudden the son wants to come in and start doing these urban deals, and it's like, okay, well that's well and good, but do you have that capacity? Do you have that experience to do that? So that's the one thing that we look for is, are you taking the company in a different direction, or is it kind of, hey, this is what we do, this is what we do well. Dad's starting to get into semi-retirement, the son's kind of coming in. We see that quite a bit. It's the ones that we keep a very sharp eye on. It's like, hey, let's go do something completely different. Oh, and by the way, too, we're going to start expanding into 20 states instead of the 2 that we've been focusing on. So that's what we keep an eye on.
I think also the shift is sort of what as the business does shift to the sons or the daughters or whatever.
Thank you. I appreciate that.
It's what's the financial capacity and who's actually still signing the guarantee? Is the dad still signing on behalf of the children or not? So that's one of the things that we're looking at. Unfortunately, one of our developers doesn't quite have some of our long-term developers don't have family members who are interested in the business. So so there is some planning that these developers are doing to sell off their portfolio, still stay involved. So we are working through that with them and with our investors, since they're obviously a key stakeholder in the deal.
And I'd say a lot of kind of your average tax credit developer are not big shops. I mean, they're a handful of folks at best. Maybe there's a family lineage of some sort. Maybe there's not. So right off the bat, we're kind of looking and asking the questions. What is the plan? And you don't have to be 70 years old to be asking this. I mean, we've had experiences over the last 20 years where something catastrophic happens, and what is the plan? And so we are having those discussions, and I think the smart ones, as they start to kind of advance a little bit and start thinking about retirement, are putting hard plans into place and actually bringing us in and saying, let me tell you what the plan is, and sort of, they've got it spelled out ahead of time, and start thinking about things ahead of time. Where do all these guarantees go, if something happened to me? Is there a trust involved? I mean, the good ones, the smart ones, start thinking about that after a certain period of time. We're definitely thinking about it from sort of day one, even if it's a 25-year-old somebody that's just starting out on this. What's the plan if something happens? So it's kind of part of our everyday stuff.
Yeah, and it's interesting too, because not just for those that are related. So we've got some in which you've got a strong developer, and they've got that right-hand guy that's been with them for like the last 15, 20 years that does a lot of the work. And we're seeing some of those guys kind of say now, it's like, I'm afraid someone's going to come and pilfer them, try to get them away to another development company. And our answer is always make them part of the business. Give them equity, give them ownership, put them in the deal. It's like, we feel comfortable. We actually like that. This is the guy that we're talking to day to day. This is our go-to guy. We want to make sure he's around too. So that we're seeing quite a bit as well.
Well, you've all been very patient and given us an hour of your time listening to us drone on about equity, but any questions from the audience, any comments, anything we didn't cover you'd like to ask a question about? I have a question for all of you. We're taking an informal poll, and I'd love any anecdotal feedback. Construction cost, subs, still an issue here in Texas? Yes? No? I can nod ahead. Still an issue? Are you seeing any relief at all coming from that? I'm talking to the gentleman here nodding in the front. Any relief coming in any?
What I see right now is there's just too much money chasing apartments,
Mm-hmm.
and a lot of them are being built, especially market rate,
Mm-hmm.
and it's really driven costs way up.
Well, I completely agree with you. I mean, we work in major markets across the country, but I think, when we were sitting here a couple years ago, also looking at all the cranes outside of the windows, we were saying, all right, well, this wave of 18,000 units here in Austin's about to finish up, and that will certainly relieve some of the pressure, and the 20,000 units in Houston, but it seems to me just generally that that's not happening, that there's not.
Dallas, they just keep building, and the money keeps chasing.
Yeah, that's what I've heard. As Houston sort of finished with its boom, or finishing its boom, all the employment is now shifting to Dallas, and it hasn't stopped up there.
Yeah, I've also heard a number of stories, and I know obviously with oil pricing where it is, I don't think it's as big of a problem, but I've heard from 2 different developers where they literally had to hire security guards to keep the poachers from the oil companies from coming and taking their sub base away. So is that still happening? You're still having a tough time getting subs on site?
It's interesting that in talking to a lot of construction companies, that it was hard to get people to work because they were going to the oil field. But now that the oil fields have clamped down, they still haven't been able to get the workers back.
To get them to come back.
That's what I'm hearing.
Okay.
You got home builders in Dallas that don't seem to be building as fast as the demand signals. Now, are they doing that on purpose, or they can't get the workers? I don't know.
Yeah. Well, Well, it seems like the pressure on construction, I mean, it has been the process of finding, I wasn't being facetious, I was being very sympathetic. I mean, the process of finding the right piece of dirt in the right place at a price, and an owner who doesn't know that his dirt is worth gold, and then trying to get your construction costs to come in, and then you have the challenge of property taxes and expenses that are there, so.
There's all kind of road repair going on, so concrete scatter off.
Yeah, one commodity, copper, finally comes down, and then concrete goes through the roof.
Yep.
Mr.
You know, one thing,
I guess that's good, though. I'm sorry, David, what?
one thing that's interesting, I think we've all seen the phenomenon, is as the supply-demand shifted so that we had to pay more for subs, everything went up and up. And I think ostensibly, at least in Houston, there is a slowdown in construction, but you're not seeing any indication of prices coming down. And one example I have is, for example, when oil prices were through the roof, we started seeing surcharges for oil costs, transportation
Costs, yeah.
on our bills. Well, now oil prices are, a third of what they were. And we still see that same surcharge on the bill. And we go in and go, we're not paying for this surcharge. And they'll take it off, but I bet most people don't even look at that and see they're still getting a transportation surcharge.
That's interesting.
I mean, I think we all have to really push back on some of these folks. They've reached this level and gotten used to it. And even though the business, I think, in some cases has slowed down, not in all cases, because these guys are working for other industries. They're not just sticking with multifamily. But I think also they've reached the comfort level with bidding at this price, and we've got to work real hard to get them back down to reality.
Yeah, it's like, here, yeah, $70. That's what I'm doing it for, and it's, it's 70. Yeah, the deals that really worry me that we've seen struggle the last couple of years are the deals that are in the tertiary markets. I mean, you think it's hard to get a framer in Dallas or Houston, try to get a framer, out to a town of, 6,000 in East Texas, and, how much it costs to bring the framing crew out, and they won't even return your calls. So it's definitely a challenge out there. But I anybody else, any thoughts on construction? Any other questions, comments? Well, I appreciate that feedback, and on behalf of all the panelists, thank you so much. Of course, we're happy to talk with you about your deals or any questions you have after the session, and really appreciate your time this afternoon and attention. Thank you.